Thank you. So good morning, and looking at how beautiful day today it is today, and just sort of thinking we're in a bit of a bubble here when we look at what's happened down south with terrible weather and a rain event down there and a few areas on fire up north. So it's a pretty unique place we are in Australia, that we've got one area that's flooding and one area that's sort of battling some bushfires. So as I was introduced, I look after an area called Trade and Working Capital. So we work alongside our regional and business banking bankers that go out and talk to clients about their working capital needs. So we're a specialist industry or a specialist field that looks after working capital, and that includes both domestic and international working capital, and things like funding inventory and funding grains and cattle and all sorts of things. So today I wanted to go into 3 different areas that we look after and give you some worked examples of what we do. And this gives really a taste of what we can do, and it's not the be-all and end-all in terms of what we can put together, but it gives you a bit of an idea of what we look at. And the reason I chose these areas is that this is what we're getting lots of requests for. So one of the areas we get a lot of questions for is large pieces of equipment or machinery that people are looking to purchase. And some of this is really hard to do because there's a number of different things with sort of how do you fund it and how do you carry it until it actually gets on farm and gets used. The next 2 is around how do we fund grains post-harvest, and how do we actually fund some cattle that might be in a feedlot. It might be small, it might be relatively large, and all the way up to intensive feedlots. So we look at the first one I want to talk about today. Oh, okay. So typically what happens when you look at a large piece of machinery is that you normally need to pay a deposit. And this deposit might be fairly long term. It might be that you need to pay a slot deposit. You might send some initial drawings, and before a manufacturer overseas or domestically wants to start work, they're saying we want a 30% deposit before we start. There's various progress payments that you need to make along the way, and there might be a final payment that you make before it gets dispatched over to your operations. And then you have an arrival and setup period that you need to make sure that's working efficiently. And where we're seeing a lot of this growth coming from is that how do you get efficiencies from farms? And a lot of that is through upgrades in terms of machinery and plant and equipment. So after that, you start using it. So if we look at that from an illustration point of view, that pretty well shows you where you get the drain of cash flow. So along the way, you've got to try and fund this in different ways and means. And you can draw down on different types of funding facilities, but what we try and do is give you a dedicated funding line that actually funds that along the way. So it actually smooths out that cash flow as you go along. So typically when you get to ready for use, you normally get that refinanced towards an equipment loan or an asset finance. So to give you an idea of how that typically works, this is the worked example. So again, you look at that, you've got a deposit you make along the way, and that's funded for the complete period of the project. You get other various drawdown payments that you need to make, and then there's a final payment. And we have those loans matured at a common maturity date. So where it actually adds value in terms of cash flow is that you can fund those and quarantine that funding all the way along until you get to the end where you need to start using that equipment, and it gets refinanced to an asset finance. So to me, the benefit of that is that whole cash flow, and that interest cost is expensed towards the end. So you're not paying interest costs along the way, and again, you're not drawing down funds against other loans you might have. So you're quarantining that amount that you actually use against that piece of equipment. The next one, we're looking at funding against grain positions. So again, how do we actually help clients accumulate grain? If you look at what the grain environment is at the moment, there is a little bit of a shortage of grain sitting out there, and people are actually keen to try and secure grain. These are either accumulators that on-sell or people use it for their own purposes. So again, we've developed a dedicated funding line for a lot of clients to actually allow them to accumulate grain and buy it at opportune times. So our funding rate really is determined against what type of grain we're funding. So we look at grain in 2 tiers. Tier 1 grain is the ones that have got a liquid market, so wheat, barley, sorghum, and we look at a different advance rate to, say, a Tier 2 grain, which might be a chickpea. Tier 2 is what we refer to it more from the fact that the market's not that liquid, as there's not an observable price. So we normally talk to clients and say, okay, what type of grain you're looking to accumulate, where you're going to hold it, what are you going to do with it, and that sort of thing, and work out what the funding rate might be against that. We determine what those advance rates are, so as you're sitting there to accumulate, you know exactly how much we can fund against that grain you're looking to buy. And as I said, they're typically used for people looking to accumulate grain to on-sell, or people looking to use it for their own activities. And like I said before, that grain's getting a little bit scarce out there, and there is grain out there, and I was talking earlier to a few colleagues, and they're seeing a lot of grain shipments coming across from the west over to the east. So again, people looking to secure grain out there and making sure they've got enough available for them. So if we look at this graphically, this is typically what happens. You have this period where you're actually going out there and buying grain, so you need to accumulate that, you hold it for a various length of time, and then you slowly draw down against it. So that funding allows you to actually go out there, purchase it and hold on to it. So we fund on physical grain held. You normally need to report to us what physical holding you have, and then we determine what is available in terms of drawdown funding. You report on that on a fortnightly or monthly basis to us. So if we look at this from a worked example, if we had 3 different types of grain, wheat, barley, and, not what have I used there, wheat, sorghum and chickpeas. That's typically the type of reporting we look to get from people. This is just a very broad example, but we look at how much volume you have, what's the purchase price you paid for it, are you marking to market or using an original purchase price, what our advance rate we've set, and that's determined on different individual circumstances, and it gives you an idea of what's available in terms of funding amount. The next one, I'm sorry that the top ends aren't sort of coming through clearly on this. So the funding of cattle. So this is an area that we've developed, and we've been doing this for the last couple of years, and it is a growing market for us, and a lot of people want to make sure they can hold cattle until they get to the end of their cycle and they're getting the maximum yield they can for it. So we developed a product that actually funds cattle and cattle holdings for people. So we typically fund trade cattle. So these are cattle that are fed for 70 to 120 days. They can be fed depending on how you're looking to feed them, whether you're giving them to a feedlot to do some custom feeding, or whether you're feeding them on your own feedlot, or whether you've got a facility you're actually adding value to those cattle. Again, it's that whole ability to purchase and carry those cattle until they get to their full spec, and it's scalable, and that's the beauty of this type of product, is it actually can allow you to go out there and grow and to hold those cattle. So again, with that leverage and assigning some value to those cattle, it allows you to keep on growing and continue to sort of get to a larger sort of producer status. And to me, it's the alternative to how do you fund it normally. So we see a lot of people funding working capital through overdraft and other means. And it gets a little bit clouded in terms of what you're funding then. You're sort of saying, well, I've got this, I'm going to buy these cattle, I'll feed them out, I'll get the funds in, I'll repay that loan, and sometimes those funds don't go back to that loan. You start getting a bit of a build-up of hardcore debt into those loans. By having a dedicated funding facility, you can do a couple of things. You can measure what the cost of funding those cattle are. You can also make sure that that loan is extinguished once those cattle are through their feed cycle. So again, it's putting some rigor around what you're doing, and it gives people a chance to reflect back and go, okay, I know what I've got available, this is how many cattle I can carry, and I know how I funded them. So it's like what we do with our grain facilities, we set different advance rates. So depending on what your circumstances are, but there's different advance rates that we set for what type of cattle we're looking to fund. So again, if we look at this from a graphical perspective, you've got that period where you purchase the cattle, you feed them out for 120 days. From there, you sell them to a processor, you get paid in 21 days. We fund that full cycle. So we fund from purchase of cattle all the way out till you get the funds in from the processor. We don't control the flow of funds. So if you tell us that you've bought 500 head of cattle, and you want to draw down $500,000, we fund that to your working account, and you disperse those funds as you want to. So that's there typically to pay the cattle yard or the purchaser that or the buyer or the seller that you've actually purchased the cattle from. And when the funds come in, typically that's matched off against what that loan is, and the two net out against each other. So if we look at that from a worked example, if we would buy 1,000 head of cattle at a purchase price of $1,250, our advance rate was 70%. That's what would be available to you from a funding perspective. So in summary, what we really want to talk to clients about is getting a dedicated working capital facility for them, because in a lot of instances we see people who've got a working capital need, but it's funded through different avenues, and there might be a general loan for a farm or an operation, but that working capital isn't separated out. So you find people getting to a point where they're getting to pinch points of their working capital. By having a dedicated facility, it's a lot easier for people to say, this is where my business is going, I need more working capital. And it's very easy to actually substantiate that to a bank and saying, this is where my working capital needs are, this is my seasonality, can you give me some funding to match it? So really for us it's about matching the need with the amount available. The other side of it is smoothing your cash flow. So a lot of times that you're waiting there, you've invested money along in terms of different cycles, whether it's planting or whether it's actually growing out some cattle. You've got a lot of money going out, and then you get this liquidation point at the end. So how do you make sure that you've got enough working capital to keep your operations going and going relatively smoothly? So you're not having this point where you're struggling to find cash to make the farm operations work. And again, finally, it's that ability to allow some leverage in terms of if you're looking to grow, and this is where sort of from grain accumulators to cattle to various other things, how do we actually give you some leverage to continue to grow? So for us, it's about understanding what those commodities are or what those asset classes are and allowing some value to be recognised against those and giving you the ability to actually leverage that a little bit more and get some scalable growth. At the moment, it's all about how do you get to be to a certain size and be an active participant. So the smaller farmers are sort of finding it that it's getting a little bit difficult to keep on getting a foothold in the market. So as you see farms consolidate and operations consolidate to getting bigger and bigger, how do you actually help, how do you find avenues to help you grow to that area?